What is it that you should be doing with individual companies and stocks? And who better than Jignanshu Gor from Bernstein to understand consumption a bit better and how these earnings are panning out? Jignanshu, hi. Great to be speaking with you. Let's talk about Trent first, Jignanshu, because, like you said, over-cannibalization of the micro market demand. I think the question really is, whether the aggressive store expansion is sort of reaching a point of diminishing returns, and how long can they sustain these kind of margin levels, and would they be range-bound going forward?
Okay, thank you so much for having me here. Always a pleasure. I think Trent is going through a reset of its Zudio strategy, like it did a reset of its West Side strategy maybe a couple of years ago, where they realized that the Zudio growth of stores, especially in the urban micro markets, has been beyond what it should have been. A more gradual approach would have been probably more sustainable. And they focused on the micro market share. Like that led to some diminishing margin profile and growth numbers in the short term. In their press release and investor presentation, they very clearly call this out, that they are now going back on that in a way and focusing more on tier 2, tier 3 expansion, which comes with its own sets of challenges. Customer profiles are different, the store economics are different. But I think that reset is what's happening right now. I don't expect the growth number to be so low going forward. We do build in a 20% growth CAGR over a next 3-year period. So that's, I think, the first point. We believe growth will return not to 25 or 30% levels, but to 20% levels. On margins, I do believe this margin is sustainable. Right? It cannot improve from here, but it is sustainable because it comes on the back of investments into technology, which they have done, largely because their employee costs have gone down and their other operating expenses, especially logistics, etc., are giving them scale-based efficiencies.
Jignanshu, you spoke about the fact that the street is penciling in a lower growth rate for Trent. If that is the situation and that and Trent is able to maintain that 20 to 25% range growth for the top line, do you see now a steep correction or derating of the PE for Trent as well?
See, I think the PE in a way has derated faster if you look at the stock price than the growth expectations have derated. We still believe that there is a 22 or 21, 22% growth expectation. We are slightly below the street in that, but we do keep it at a 60 odd multiple, given the fact that we expect the franchise to do well. They are making all the right decisions, all the right choices in terms of where to open stores, how much to churn the inventory, how quickly, how to react to competition. So as a franchise, I don't expect the best fashion franchise in India to derate. Of course, until the growth tanks below this. Like we don't right now, I don't think the valuation factors in a scenario where the growth tanks further. If that happens, I think that I can expect. That's the only scenario where I expect a significant derating from here on.
Jignanshu, so the key upside here is going to be growth coming back, right? I'm trying to understand where have things gone wrong with regard to growth. Is it the higher competition? And as they enter tier 2, tier 3, you're seeing some of the other value retailers also being present, and they will be very real competition for Trent. Is that at all a risk, growth coming back itself?
Yeah, fair enough. So where has it gone wrong? I think it's a combination of many problems. One was, as we have discussed, over cannibalization of stores, which hurts, but it's a time effect. Second is they've sort of reached the market share ceiling in some markets where there is a brand fatigue, which always happens with fashion retailers because people don't want to wear the same clothes that they see many other people wearing. So there is a natural ceiling of market share then that a fashion retailer can get in any micro market. That's the second thing. The third thing is that their store growth became a little erratic because they needed larger stores and they wanted to go to new cities, which needed replanning in the organization. Fourth is consumption overall, a softer consumption environment, especially in urban areas. And then the fifth part is competition. And even in urban areas, we do see increased competition, though the impact is lower in our view, but there is obviously some impact. When they go to tier 2, tier 3, Harsh, for your second part of the question, I expect the competition to be there, but not as severe as what they actually saw in metros and tier 1. Because the competition, I do believe that the positioning that, let's say, a Vishal Mega Mart or a V Mart or even a V2 retail has is slightly different from the positioning that a Zudio has. I think Zudio is far more uh, younger population, far more fashionable clothes, if I were to say that. Whereas the other value retailers are more family oriented value propositions across ages, as well as a lot of basics in their design. Whereas Zudio has a lot more fashion in its design. There will be some competition, but I think not more than what they've faced in metros.
Understood. So much insight. Jignanshu, thanks as always for your time.
As usual. Thank you so much. Pleasure.
How is it that you should be looking at IT at this juncture right now, and what really could be, the impact of the SaaSpocalypse, which is currently playing out across the world? Let's try and understand with Moshe Khatri and hear out his views on what he's making of all these developments. Moshe, great to have you on ET Now. Thank you for your time. Moshe, we've seen this major tech sell-off, both in the US and its impact here in India as well on the IT services majors. Tell me, do you think this is just panic over what Anthropic is going to do and what the Claude model is going to do? Or is this more of a structural issue that we saw play out?
This almost feels like deja vu because we've been literally talking about this for 2 years. The industry has been going through concerns related to discretionary spending, concerns related to the disruptive impact of Gen AI, concerns related to the disruptive impact of GCCs. All this has been going on for 2 years. All I can say is that a couple of things. First, near term, if you look at the earnings releases from most companies that came out, it seems that the numbers are probably a bit better than expected, and it seems that guidance for the next 6-12 months is a bit better than expected, number one. Number two, most companies in the space have been really aggressively changing their model. If you want to be able to survive this Gen AI disruption phase, you have to do two things. You have to decouple the whole thing around revenue growth from headcount growth. And then you also have to start focusing more on performance-based contracts rather than T&M or, the traditional model. And a lot of companies are actually focusing on that as well. So these are all good things, positive developments. And then on top of that, if you really want to benefit from this Gen AI spending cycle, a lot of companies are focusing on this from the infrastructure side of the business, i.e., the data piece, the integration piece. These are all areas that are very, very well, I would say companies are very well positioned to succeed in these areas. So that's how I kind of see that. The recent sell-off seems to be more like panic selling than anything else to me. But also you want to add the fact that it wasn't only Anthropic that spoke about the release of these new products, but the same day you also had Gartner that came out with numbers and actually gave guidance that was much weaker than what people kind of expected for calendar 26. So that added to this whole, panic selling. But net, it seems that the next 6-12 months are going to be better than what we've seen in the past 2 years in terms of growth rates for the industry. So I am, I'm probably a bit less concerned about, where the industry is going, just given some of those aggressive moves that have been taken by many, many vendors in the space.
Not as disruptive, Moshe. That's what I'm hearing from you. You seem more constructive, more positive. What's giving you that confidence that there won't be as large a disruption as the market seems to be building in?
As I said, some of the strategic moves that are being undertaken by vendors in the space, reskilling, the model changes, and then some of the relationships, strategic partnerships that have been formed by some of the vendors in the space. I've been around 10 years ago when cloud, the whole thing around cloud was kind of a new theme. And back then, the common belief was that the shift to the cloud will eliminate the need for software custom software application development. So the typical belief 10 years ago was that any sort of need for consulting pretty much is going to go away. And here we are 3 years after that. The whole cloud phenomena created a new spending cycle on the integration side, a very large one for the space. And I think that we're headed towards a very similar kind of scenario here, where we're going to go from an extremely bearish scenario for the space to probably more constructive. And so that's how we kind of see it.
So, Moshe, how should investors be looking at this opportunity right now? Would you say that one is going to resent not buying into the fall, maybe even a year, 2 years down the line?
I would say that investors are pretty much equally split in terms of their outlook for the space. We still talk to some people that are very, very bearish about the outlook, and then people that are probably a bit more constructive. So it really depends on how you kind of look at this. And I would say it's still pretty controversial. You definitely don't have a unified thought about where the industry is going to go. If you're, obviously a year from now, things are going to look a bit different in our view in terms of growth rates and in terms of the multiples for the space.
Moshe, how would the IT environment as a whole change? So, of course, you're making a case that they will adapt and they will likely have to adopt AI to a certain extent as well. They've been behind the curve there. Is that at all a concern? And how do the numbers therefore change? Do employees start to come down? Do we start to see revenue also come down? Do we see margins start to inch up? Efficiencies go up? Revenue per employee go up? What are the parameters?
So it's not only about that. It's also not only about model changes. It's also about some of the Gen AI projects reaching scale. I think the biggest issue here is that a lot of these have not reached scale. Once you reach scale, there's going to be more spending on data manipulation, on integration. And this actually will drive growth for the industry. It could happen 6 months from now. It could also happen 12 months from now. So that's what we're kind of looking for. In terms of some of the metrics, we should see, as you said, better numbers in terms of billable headcount, revenue per billable headcount. And then on top of that, we should also see better margins for the space. And it is ironic because a year or 2 years ago, there was a lot of concern about margin compression. And ironically, that's not what we're seeing. We're actually seeing margins improving. Again, because you are decoupling revenue from headcount growth. And because you are focusing more on performance-based contracts and fixed price work. If you know how to do this, you should do extremely well on both fronts in terms of revenue per billable and in terms of margins. And there are some companies that are getting there. there's a publicly traded company called Huron. Their symbol's HURN. They do performance-based contracts, and they have done exceptionally well even in this environment. So model changes, you're going to see that reflected in metrics, but on top of that, you need to see some of those Gen AI projects reaching scale, and this is where you're going to see projects getting larger for the space.
And Moshe, I wonder if at all, therefore, will the winners over the next maybe 5-10 years be materially different from the companies which have won in the last couple of decades? And therefore, will a new set of winners likely emerge? Or will the existing companies continue to grow larger in size and pretty much in tandem with the others?
So in our view, the tier ones that are based out of India are very well positioned to participate in this spending cycle, given their integration expertise and given some of the work they're doing in data. And you will see some others that are very specialized that are continuing to do well. Gen AI is one area, product development, ER&D. These are very specific areas, and you will see companies that are very, very much focused on those specific niches that are growing faster than the industry. Many of them are private. Some of them will go public. Some of them will get acquired. But I would say a bit of both. The larger companies, in our view, are well positioned, and you have some more specialized companies in the space. And you'll hear those names once they go public.
And last off, I want to try and understand what happens on the margin count. I'm not sure if I caught that fully or not. Do you expect, therefore, the margin trajectory to be materially different? Maybe it may take a couple of years to get there, but will margins therefore change structurally for some of these names?
In our view, because of the productivity improvement and because you're decoupling revenue from headcount growth, this should actually help margins for the space. I don't know if margins are going to double. I don't know if margins are going to be up, X amount of basis points. But based on what we're seeing, this whole concern about margin compression has been overblown. That's for sure.
Okay, Moshe, thank you so much. This has been extremely informative, and your views always very, very well valued. So thank you so much for coming in and speaking with us.
Thank you. Have a good one.